It was once one of Wall Street's most admired firms, a symbol of resilience, ambition, and success. But beneath the towering reputation of Bear Stearns lay a ticking time bomb, one that would ignite the collapse of the global financial system.
Bear Stearns, one of the most admired firms in America, now one of the most endangered.
From its meteoric rise to its catastrophic fall, Bear Stearns almost single-handedly set the stage for the financial chaos that would engulf the world, becoming the first domino in a crisis that redefined Wall Street forever.
American investment bank in trouble, running out of money, perhaps on the verge of going out of business.
What happened to Bear Stearns and the investment banking sector over those days determined the livelihood and the lack of livelihood for millions of people in the months and years that came after that.
Bear Stearns is definitely the most exposed to the mortgage situation.
The subprime mortgage crisis first hit Bear Stearns last summer.
So in just 6 months, 3 of the 5 biggest independent firms on Wall Street have now disappeared. Bear Stearns, which collapsed last spring,
In 1923, America stood on the precipice of change, basking in the glow of the roaring prosperity. Cities hummed with the rhythm of the Jazz Age. The economy boomed, fueled by the rise of mass production and consumerism. Model Ts lined the assembly lines, and radios brought the nation together like never before. Wall Street mirrored this exuberance, with stocks soaring as everyday Americans joined the investment frenzy. Around that time, a small partnership quietly took root on Wall Street. Joseph Bear, Robert Stearns, and Harold Meyer founded Bear Stearns with $500,000 in capital and a bold vision: to thrive in a market of boundless opportunity and volatility. Bear Stearns began as a small partnership focused on trading and brokerage services. Their business model revolved around serving smaller clients who were often overlooked by larger, more successful Wall Street firms. They specialized in buying and selling securities, acting as intermediaries for clients who wanted access to the bustling financial markets of the Roaring '20s. Their nimble size and willingness to take calculated risks set them apart, enabling them to capitalize on market opportunities that bigger firms might have deemed too small or too risky. In the years following its founding in 1923, Bear Stearns quickly carved out a niche for itself on Wall Street, capitalizing on the booming economy of the Roaring '20s. Their reputation for agility and risk-taking earned them early success, bolstering their capital base and attracting attention in a crowded field of larger, more established firms. The firm's founding trio, Joseph Bear, Robert Stearns, and Harold Meyer, were strong personalities with clashing visions for its future. Joseph Bear, seen as the driving force, was fiercely ambitious, but often at odds with Stearns, who preferred a more conservative approach. Meyer, the third partner, tried to mediate, but often found himself caught in the middle of escalating tensions. The power struggles culminated in Stearns' abrupt departure in the late 1920s, a dramatic split that threatened to destabilize the fledgling firm. Despite the turmoil of its internal power struggle, the challenges within Bear Stearns would pale in comparison to the upheaval about to sweep Wall Street, as the firm hurtled toward the year 1929. In October 1929, the unthinkable happened. The stock market, which had roared through the 1920s, collapsed in a spectacular implosion. What began as a jittery sell-off on October 24, Black Thursday, escalated into sheer panic by October 29, Black Tuesday.
On October 29, Black Tuesday, the bottom dropped out. The average price of major stocks falling nearly 40 points. There was chaos at the New York Stock Exchange.
Stocks plummeted as investors scrambled to liquidate their holdings, erasing billions of dollars in wealth almost overnight. While other firms had over-leveraged in speculative stocks, Bear Stearns had maintained a relatively conservative balance sheet, avoiding the worst of the mania. Joseph Bear, determined to protect his clients and the firm's reputation, insisted on preserving liquidity at all costs. Liquidity refers to cash or assets that can be quickly converted to cash without losing value. For Bear Stearns, preserving liquidity meant having enough readily accessible funds to meet obligations, pay clients, and sustain operations, even as the financial system around them froze during the 1929 crash. Against all odds, Bear Stearns weathered the storm, emerging scarred but intact, ready to rebuild in a world forever changed. The 1930s scarred America, but by the early 1940s, recovery took root. Roosevelt's New Deal reshaped the economy with reforms, public works, and safeguards like the SEC to stabilize Wall Street. As World War II mobilized industry, unemployment fell and prosperity returned. Wall Street, battered by distrust, began rebuilding under stricter regulations. Investment banking evolved, catering to wartime financing and post-war growth. By the late 1940s, optimism had returned. The market began a steady climb as Americans reinvested in stocks and businesses thrived in the booming post-war economy. Wall Street, chastened but resilient, prepared for its next great ascent. Around this time, Bear Stearns was a small-scale but rising player on Wall Street, thriving in a post-war economy ripe with opportunity. The firm focused on risk arbitrage, profiting from price discrepancies during mergers and reorganizations, a bold yet calculated strategy. Risk arbitrage is a strategy where investors try to profit from price differences in a company's stock during events like mergers, acquisitions, and reorganizations. For example, if a company announces it's being bought at $50 a share and it's currently trading at $48, investors buy the stock betting that the deal will close and the price will rise to $50 a share. Bear Stearns in the 1950s specialized in this. They analyzed such deals to determine whether they would succeed. However, it was risky. If the deal failed, the prices would drop. But Bear Stearns used careful research to maximize profit and minimize losses. It expanded cautiously, focused on high-margin opportunities while avoiding excessive debt, a philosophy rooted in the painful lessons of the Great Depression. But a new leader emerges, determined to change all of it, and take Bear Stearns to unprecedented heights. Born in New York City, Cy Lewis was known for his sharp instincts and a fearless approach to the markets. He began his career at Bear Stearns in the 1930s as a bond trader, quickly gaining a reputation for his ability to navigate complex financial instruments and capitalize on market opportunities. During the post-war era, as Wall Street evolved, Lewis became a key figure in Bear Stearns' risk arbitrage strategy, identifying lucrative opportunities in mergers and acquisitions. As a trader, Cy Lewis bought and sold stocks and bonds on behalf of Bear Stearns or its clients. In the 1930s and 40s, Cy Lewis specialized in bonds, which are essentially loans that a government or company issue to raise money. He would analyze market trends to find bonds that were mispriced or had strong potential for return. His quick decision-making and deep understanding of market trends helped Bear Stearns earn consistent profits. As the president, Cy Lewis realizes that Bear Stearns needs to expand in risk arbitrage, a field he had mastered early in his trading career. He has a huge appetite for risk. At the time, the firm was all about expanding. Lewis's aggressive approach sometimes created tension among the firm's partners, especially those wary of his appetite for risk. Despite his risk-taking and aggression, Lewis's accomplishments were monumental. By the late 1960s, Bear Stearns had firmly established itself as a Wall Street force. By 1978, the firm's revenues had grown substantially, and its client base expanded to include some of the most prominent names in finance and government. But he has no idea what is about to happen next. Seeing his company become a successful firm on Wall Street, Cy Lewis decides the time has come for him to retire. But he needs to also showcase his legacy in a grand exit. A grand farewell dinner had been arranged to celebrate his remarkable career and his enduring contribution to Bear Stearns. On the evening of the dinner, Lewis was in high spirits, mingling with partners, clients, and colleagues who had gathered to honor him. As speeches praised his brilliance and boldness, his colleagues reflected on how Lewis had transformed Bear Stearns with his sharp instincts, fearless approach to trading, and a relentless pursuit of growth. However, during the celebration, Lewis suffers a sudden, fatal stroke.
Cy Lewis, the distinguished chief executive officer of Bear Stearns and a towering figure on Wall Street, has died. Mr. Lewis suffered a stroke during his farewell celebration, widely respected for his leadership and legacy in American life.
His death was not just a personal tragedy, but a turning point for the firm. Bear Stearns was left grappling with the sudden absence of the man who had been its guiding force. But in his demise, a new leader will rise to the helm. Born in Oklahoma City, 1927, Greenberg grew up in a modest Jewish household, where his father's entrepreneurial spirit left an indelible mark. After earning a business degree, he arrived in New York City in 1949 with just $3,000 in his pocket and a relentless drive to make a mark on Wall Street. He started as a clerk in the oil and gas department, his days spent sticking pins into maps to track exploration activity. But Greenberg was no ordinary employee. He quickly immersed himself in the firm's trading operations, learning the nuances of the market. His big break came when he lobbied for a spot on the arbitrage desk, an arena where quick thinking and nerve were critical. And Greenberg excelled, proving his mettle in a high-stakes environment by identifying and executing complex trades. One of his defining moments came in the 1950s with American Viscose, a merger deal that tested his instincts. Greenberg had sold off a significant chunk of underperforming stocks from the firm's inventory and reinvested it in the merger. The decision wasn't just bold, it was transformative. The gamble paid off, bringing in substantial profits and cementing his reputation as a trader who understood risk better than most. This pivotal moment solidified his role as a leader within the firm, earning the trust of his peers and superiors alike. In the late 1970s and early 1980s, the Wall Street landscape was undergoing significant change. The deregulation of fixed trading commissions in 1975 has squeezed profit margins for traditional brokerage operations, forcing many firms to diversify their income streams. Many firms struggled to adapt. But Greenberg saw this as a moment of opportunity. Clearing, the back office process of settling trades and ensuring that buyers and sellers received their respective securities and payments, was an unglamorous but essential aspect of the financial industry.
Clearing is like the behind-the-scenes operation that make all stock trading possible. For example, two people make a deal. The seller wants to sell a stock and the buyer wants to buy one. Clearing makes sure that the seller actually delivers the stock and the buyer pays for it. All of this ensures that a trade is completed correctly and both parties get what they're owed. Bear Stearns focused on offering this service to smaller brokerages. Smaller brokerages couldn't handle all the complicated paperwork and coordination all on their own, so Bear Stearns stepped in, offered to do it for them, and charged a fee for doing so.
This focus aligned with Greenberg's philosophy of protecting liquidity and minimizing risk. Unlike high-stakes trading, clearing generated consistent, predictable income and positioned Bear Stearns as a behind-the-scenes powerhouse. Under his leadership, the firm invested in state-of-the-art clearing technology and built a reputation for reliability. By the mid-1980s, Bear Stearns was processing about 10% of all trades on the New York Stock Exchange, a testament to the business's rapid growth. But to grow, Greenberg realizes the firm will need more capital, and to do that, in the 1980s, the firm needs to go public. By the 1980s, to remain competitive against larger, capital-rich rivals, Bear Stearns needs more funding to fuel its growth. For years, Bear Stearns had operated as a private partnership, where the firm's partners invested their own money into the business. But by the 1980s, the limits of this structure were clear. Wall Street was transforming into a more globalized, capital-intensive industry, and firms that went public had access to vast new pools of money. In 1985, Bear Stearns launched its initial public offering, offering 10 million shares at $21.50 each. The offering was a resounding success, with shares tripling in value on the first day. And as Bear Stearns basked in the success of its public offering and expanded its reach, a storm was quietly brewing on the horizon, one that would sweep through Wall Street and forever be remembered as Black Monday.
Good evening. Today is Black Monday, the day the Dow dropped more than 500 points, the day the Dow dropped more than 22%, almost double the rate of the Black Monday that signaled the beginning of the crash of 1929. But this crash of 1987 is not just an American experience. Around the world, stock markets fell faster than a skydiver without a parachute. The panic starting in Tokyo this morning while the West slept. One cause of the sell-off was...
On October 19, 1987, the unthinkable happened. The stock market plunged into chaos. Dubbed Black Monday, it was the single largest one-day drop in Dow Jones history, with the index free-falling by 22.6%.
Investors were gripped by panic as computer-driven trading algorithms accelerated the sell-off, creating a domino effect of fear. Fortunes vanished in hours, leaving Wall Street reeling. The crash exposed deep flaws in the market structure and raised questions about its unchecked volatility.
In the weeks leading up to the crash, Greenberg had been very wary of the market's frothiness. His emphasis on protecting liquidity, a cornerstone of Bear Stearns' ethos, meant the firm was less leveraged than many of its competitors. Greenberg's rule was clear: never overextend. This caution shielded the firm from the worst of the carnage when the market unraveled.
As panic engulfed Wall Street, Bear Stearns traders relied on the disciplines that Greenberg had drilled into them. Weekly risk meetings had instilled a culture of cutting losses quickly and avoiding speculative gambles, ensuring that Bear Stearns was not saddled with unsustainable positions.
In the aftermath, while many firms struggled to regain their footing, Bear Stearns emerged as a pillar of resilience. But such prudent principles will soon be forgotten as a new leader emerges and Ace Greenberg's retirement looms. The man who will alter the fate of Bear Stearns forever hails from a humble origin. Jimmy Kane grew up in Chicago in a middle-class family. Restless and ambitious, he attended Purdue University, but left before graduating. From selling adding machines to driving cabs, Kane hustled to make a living. But his true calling came when he discovered bridge.
This is very common amongst finance people. Almost 80% of them love card games, which makes sense because finance really is a probabilistic game.
His big break came in 1969 through a chance introduction to Alan Ace Greenberg of Bear Stearns. Greenberg, impressed by Kane's confidence and charm, took a gamble on the brash newcomer, offering him a position as a retail broker. Kane's natural salesmanship quickly set him apart. He built strong client relationships, often using his bridge skills to woo prospective clients and close deals.
Though he lacked formal finance training, Kane's street smarts and relentless drive carried him through.
By the late 1980s, he had maneuvered his way into the firm's upper echelons, eventually becoming president. In 1993, Kane reached the pinnacle, succeeding Greenberg as CEO. Kane wants to build his own legacy. While the clearing business remains profitable, he wants to look for a new edge that he can call his own. By the late 1990s, a new type of business is booming: the mortgage-backed securities. It is the year 1990, and America is shaking off the remnants of a savings and loan crisis that rattled its financial foundations. The housing market, long seen as a stable cornerstone of the American dream, is ripe for reinvention.
The concept of mortgage-backed securities is deceptively simple. Take thousands of individual mortgages, which are home loans for everyday Americans, bundle them together, and sell slices of that bundle to individual investors. Each slice or security offers a return based on the steady stream of monthly mortgage payments. Now, to the architects of this system, it is a perfect alchemy. Banks offload their risk, individuals get affordable housing loans, and investors get a steady income stream. Seems like everybody wins. By the mid-1990s, the MBS market is booming. Advances in computing allow firms to analyze vast pools of mortgages with unprecedented precision. Kane saw an opportunity to establish Bear Stearns as a leader in this lucrative, rapidly evolving field. He encouraged the firm's fixed income division, led by Warren Spector, to aggressively underwrite and trade mortgage-backed products. This initiative helped the firm capture significant market share and generate record profits during a housing market that seemed unstoppable. Under Kane's leadership, Bear Stearns experienced an era of soaring profits. The firm consistently posted record earnings year after year, driven by its aggressive approach to trading, investment banking, and proprietary trading. In 2001, Bear Stearns opened its gleaming new headquarters at 383 Madison Avenue in New York City. The state-of-the-art building symbolized the firm's success and ambition. But for Jimmy Kane, the new headquarters was more than just an office. It was a monument to Bear Stearns' rise from a modest partnership to a Wall Street powerhouse. By the early 2000s, its stock price had climbed to all-time highs.
reaching over $170 per share in 2007. The firm was routinely ranked among the most admired companies in finance, a testament to its ability to outmaneuver competitors and deliver strong returns for its shareholders. But beneath the dazzling success and record-breaking profits, cracks were quietly forming in the foundation of Bear Stearns. Bear Stearns' triumphs were about to face their ultimate reckoning. In the early summer of 2007, the first tremors, or what would become a catastrophic collapse, began to ripple through Bear Stearns. There are two of Bear Stearns' hedge funds, which had been designed to profit from the housing boom. These funds were heavily invested in complex mortgage-backed securities, including subprime loans, which are high-risk mortgages often given to borrowers with shaky credit. For years, the strategy paid off handsomely, generating substantial returns and cementing Bear Stearns' reputation as a master of the mortgage market. But by early 2007, the housing market began to falter.
One of the biggest clouds hanging over the economy right now is that a rising number of homeowners quite simply can't pay their mortgages. Foreclosures have hit a record high. Many more borrowers are a month or more behind on their payments, and we saw the effects on Wall Street earlier.
Subprime borrowers, lured by risky, adjustable rate loans, started defaulting in record numbers as their payments soared. In June 2007, the trouble surfaced. One of the hedge funds, the Bear Stearns High Grade Structured Credit Fund, had faced significant losses, and margin calls began piling up.
Margin call occurs when your investments drop in value and your broker needs you to add more cash or assets to cover your shortfall. It's like getting a bill for more money because what you have is not enough anymore.
The second fund, the Enhanced Leverage Fund, was even more exposed, amplifying its risk with borrowed money. By mid-June, both funds were hemorrhaging cash as creditors and investors scrambled to withdraw. The situation spiraled quickly. Credit markets tightened and buyers for the fund's assets disappeared. Bear Stearns, desperate to avoid a public collapse, injected $3.2 billion into the high-grade fund. A dramatic rescue effort meant to stabilize the situation and reassure investors. Jimmy Kane hopes that the hedge fund situation is just a glitch, and the $3.2 billion infusion is enough to stabilize the situation, and he can get back to playing golf and bridge. But the attempt backfires. Instead of restoring confidence, it amplifies doubts.
On Wall Street, perception can be as dangerous as reality, and rumors spread like wildfire. The very act of injecting such a massive amount of money into the fund implied that the fund was doing far worse than what Bear Stearns was publicly admitting. Investors saw this as a red flag, proof that the fund was in dire straits. Investors panicked, pulling their money from the funds. Creditors refused further support. The Enhanced Leverage Fund, even more exposed due to heavy borrowing, collapsed entirely, dragging the high-grade fund down with it. By July 2007, both funds were effectively worthless. The losses totaling billions sparked lawsuits and shattered Bear Stearns' once sterling reputation. Worse, the firm's credibility on Wall Street was in freefall. The collapse of Bear Stearns' two hedge funds in mid-2007 was just the beginning. What followed was a slow, agonizing descent into a crisis as the firm grappled with the fallout. Liquidity, the lifeblood of any financial institution, became Bear Stearns' Achilles heel, and the hedge fund disaster amplified fears about the firm's balance sheet. Bear Stearns had significant exposure to mortgage-backed securities, many of which were tied to the deteriorating subprime market. As defaults mounted and the value of these securities plummeted, investors, counterparties, banks, hedge funds, and other financial institutions became skittish.
Whispers turned into outright panic. And suddenly, Bear Stearns' trading partners began pulling their funds and cutting credit lines. Each day, Bear Stearns needed to roll over billions in loans. And as trust eroded, lenders demanded more collateral or outright refused to renew. By March 2008, the liquidity crisis had reached a breaking point. Clients and counterparties withdrew in mass, and the firm faced the grim reality of running out of cash within days. Out of options, Alan Schwartz, Bear Stearns' newly appointed CEO, reached out to the Federal Reserve for help.
The Federal Reserve, commonly referred to as the Fed, is the central bank of the United States, responsible for managing monetary policy, including interest rates and the supply of money, to promote economic stability and growth. Within this system, the Federal Reserve Bank of New York plays a crucial role in financial market operations, as it is located in the heart of U.S. finance, which is New York City.
For decades, the Federal Reserve Bank of New York had served as Wall Street's backstop, stepping in during times of crisis to prevent broader market collapse. Schwartz hoped the Fed could provide emergency liquidity, but their response was clear. Bear Stearns needed a buyer. Jamie Dimon is the most powerful banker on Wall Street. Known for his sharp financial acumen and hands-on management style, Dimon had transformed JP Morgan into a powerhouse, weathering crises and navigating risk with a focus on long-term stability. Under his leadership, JP Morgan had emerged from the 2007 credit crunch in a relatively strong position, thanks to its conservative approach to leverage and risk-taking. Dimon's reputation as a pragmatic dealmaker and financial strategist made him the perfect figure to step into the chaos surrounding Bear Stearns.
The buyout of Bear Stearns in March 2008 was a dramatic and unprecedented intervention aimed at preventing the firm's collapse from triggering a wider global financial meltdown. The deal was orchestrated in a single frantic weekend with tense negotiations between Bear Stearns, JP Morgan, and the Federal Reserve Bank of New York.
On Thursday, March 13, 2008, Bear Stearns informed the Federal Reserve that it would run out of cash the next day. Without immediate assistance, the firm faced bankruptcy, which could destabilize the already fragile financial system. To contain the crisis, the Fed extended an emergency $25 billion loan to Bear Stearns through JP Morgan Chase to provide short-term liquidity. However, it quickly became clear that the loan would not restore confidence or resolve Bear Stearns' underlying issues. A sale was the only viable solution. Dimon recognized the strategic opportunity Bear Stearns presented, including its valuable clearing business, prime brokerage operations, and real estate assets. However, he was wary of the risk associated with Bear Stearns' toxic mortgage-backed securities and the potential legal liabilities tied to the firm's collapse.
The deal to acquire Bear Stearns was a fire sale. On March 16, 2008, JP Morgan agreed to purchase the firm for $2 per share, a shocking drop from the $170 stock price a year earlier, valuing the deal at $236 million. To mitigate the risk, the Federal Reserve backed $30 billion of Bear Stearns' most toxic assets through Maiden Lane LLC, ensuring that JP Morgan did not absorb the firm's most toxic holdings. Outrage from investors who saw their investments wiped out prompted JP Morgan to raise the price to $10 per share, a totaling $1.2 billion. A modest reprieve, but a far cry from the firm's former glory.
In the midst of all this, the U.S. government provided $30 billion in loan guarantees to prevent this investment banking firm from collapsing. Bear Stearns was on the verge of bankruptcy when the Fed's multi-billion-dollar package facilitated its sale to J.P. Morgan Chase.
The deal closed in late 2008, J.P. Morgan absorbing Bear Stearns' operations and employees. For J.P. Morgan, the acquisition provided significant strategic advantages, including a stronger position in prime brokerage and clearing. For Bear Stearns, it marked the humiliating end of an 85-year legacy, with its once proud name disappearing from Wall Street. For Bear Stearns employees, the deal was devastating. At its peak, the firm had nearly 15,000 employees, many of whom had invested their careers and personal savings into the company's stock. The stock's collapse, coupled with the fire sale to J.P. Morgan, wiped out the life savings of countless employees. Although J.P. Morgan absorbed some of the staff, thousands were laid off as the firm consolidated operations and eliminated redundancies. Entire departments, particularly in areas related to mortgage-backed securities, were shuttered. After Bear Stearns' collapse, fear gripped Wall Street. Lehman Brothers faltered, unable to secure a buyer, and filed for bankruptcy, triggering a global panic. Markets plummeted, and credit froze as banks hoarded cash. Merrill Lynch, teetering on collapse, was sold to Bank of America, while AIG faced insolvency as its credit default swaps unraveled. With the financial system on the brink, the Federal Reserve and the U.S. Treasury intervened, orchestrating emergency bailouts and capital injections, and the $700 billion TARP program, attempting to stave off a complete economic meltdown. The collapse of Bear Stearns left a trail of legal and personal fallout. Hedge fund managers Ralph Cioffi and Matthew Tannen faced criminal charges for allegedly misleading investors, but were acquitted in 2009. Lawsuits from shareholders followed, with J.P. Morgan, Bear Stearns' new owner, paying billions in settlements over toxic mortgage-backed securities. Former CEO Jimmy Kane retreated into quiet retirement, his wealth and reputation shattered. Alan Schwartz, the final CEO, joined Guggenheim Partners to rebuild his career. The collapse of Bear Stearns became a defining moment in the financial crisis, a harbinger of systemic risk hidden within the financial system. The firm's aggressive approach, heavy reliance on mortgage-backed securities, and high leverage ratio has become a cautionary tale in risk management. Bear Stearns is frequently cited in business schools, regulatory commissions, and documentaries as a case study of the dangers of overconfidence and unchecked risk-taking.